Welcome back, investors. In this video, we're breaking down the Q2 performance of Afcons Infrastructure, one of India's largest and most respected engineering and project companies under the Shapoorji Pallonji Group. Afcons is currently trading around 415 per share, in a 52-week range from 390 to 570, and the company holds a market cap close to 15,500 crore. In the infrastructure and EPC sector, Afcons delivers big-ticket projects both in India and abroad. The business covers everything from bridges and tunnels to metros, marine works, and even oil and gas structures. With over 60 years of experience, Afcons has completed more than 80 projects across 17 countries. By the end of September 2025, the company reported a robust order book of 32,681 crore, giving plenty of visibility for the quarters ahead. On the leadership side, this quarter saw some new additions to the board. Mr. Palin Mistry, Mr. Firoz Cyrus Mistry, and Mr. Santosh Nayar joined to add strategic strength at the top. Meanwhile, Mr. Shapoorji Pallonji Mistry remains as Chairman Emeritus, providing continuity and vision for the long term. Let's talk numbers for Q2. Revenue from operations stands at 3,101 crore, just a slight rise over last year. EBITDA is at 401 crore, down a bit, and EBITDA margin has come to 12.9% compared to 13.8% a year ago. Profit after tax is at 105 crore, seeing a 22% drop year-on-year, while earnings per share are at 2.85 versus 3.97 previously. Margins took a hit, mainly due to the extended monsoon and slower project execution, though the company managed to keep things stable through good cost controls. Zooming into the order book, Afcons ends the quarter with 32,681 crore total orders. Here's how it breaks down. Urban infrastructure and metro projects make up 54%, hydro and underground 25%, marine and industrial 13%, and surface transport plus oil and gas 8%. The company snagged another 1,268 crore in new orders during the first half of the year. Executive Chairman Mr. Subramanian Krishnamurthy commented that despite the tough weather and slow order inflow, Afcons has maintained stability in both revenue and profitability. The focus stays on disciplined execution, controlling costs, and creating value for shareholders. The company expects the second half of FY26 to improve as the weather clears and government spending on infrastructure ramps up. At 415 per share, the stock hovers near its lower range, reflecting a short-term slowdown. However, institutional investors are still moderately positive, given the huge order book and prospects of improved execution. The dividend yield is modest, about 0.5%, which matches the company's preference for reinvesting in growth. Looking ahead, Afcons is focusing on boosting execution efficiency, sharpening its bidding strategy, growing internationally, and riding on the government's big spending on transport and metro projects. With a healthy balance sheet and a strong pipeline, the company is well set for future growth. For investors, the entry zone is 400 to 430. Profit booking makes sense around 500 to 550, and long-term targets for the next year or so are between 600 and 700. In the short run, upside looks limited until execution improves, but the long-term view remains positive due to order visibility and leadership in the EPC space. All in all, Q2 was steady but cautious for Afcons. Margins felt some pressure, but strong order flow, cost focus, and a diverse project base lay the foundation for a good recovery. As India's infrastructure spending takes off, Afcons is well placed to benefit from the next round of growth. In summary, Afcons is building not just roads, bridges, or metros, it's working on a solid foundation for the future. The short term looks steady, and long-term growth potential is strong for patient investors. If you found this analysis helpful, don't forget to like, share, and subscribe for more stock updates and in-depth company result breakdowns every week.